Hi everyone, in this video we are going over A-Level Accounting 2023 February-March paper 3-2, question number 3. So this is the structured paper 3 which consists of 3 questions. Each of them will be of 25 marks and we're also given a time limit of 1 hour and 30 minutes, which means that ideally we should be spending about 30 minutes in order to solve each question. In this video as well, we will be attempting to solve this question under 30 minutes. I will also be linking this question paper as well as the mark scheme in the description box below. So without any further delay, let's get started. The draft statement of financial position of T Limited at 31st December 2022 is as follows. So this is the closing date, which means that all of these will be our closing balances. Alright, then we're given additional information. Okay, this probably relates to our international accounting standards. So let's have a look at our first question. We need to explain, with reference to the relevant international accounting standards, the appropriate accounting treatments for the items in information 4. Okay, we also need to support our answer with calculations. Let's have a look above. For information 4, we are given the carrying value of a motor van. So this relates to our non-current assets, which means that this is going to be our International Accounting Standard 36, impairment of assets. Let's write it down. So International Accounting Standard 36, which is impairment of assets. All right. Then we're given the carrying value of 27,000 was included in the value of the non-current assets on 31st December 2022. The value of motor van was reviewed on that date and it had a value in use of 23,200. Okay, so let's write down our carrying value of 27,000 and the value in use of 23,200. So carrying value is of 27,000, whereas the value in use is of our 23,200. Then we're also told that if it were sold, it could be sold for 24,500, but a selling cost of 1,800 would be incurred. This means that the fair value is going to be our selling price minus the selling cost. Let's write it down. So fair value is going to be the selling cost of 24,500 minus our selling cost of 1,800, which results in the value of 22,700. Now, we have to compare our value in use to our fair value in order to figure out the recoverable amount, because recoverable amount is the higher of fair value and value in use. And in this case, we have the value in use of 23,200, whereas the fair value is only 22,700, which means that our recoverable amount is going to be 23,200. So recoverable amount is 23,200. Then the next step would be to compare the recoverable amount of 23,200 to the carrying value of 27,000. So we see whether the recoverable amount is less than the carrying value, and in this case it is definitely lower than the carrying value, right? And whenever that's the case, there will be impairment loss. So the impairment loss is just going to be the difference between our recoverable amount and the carrying value. That is going to be 27,000 minus 23,200, which results in 3,800. So this is the impairment loss, and now this should be recognized in the statement of profit or loss. Impairment loss of 3,800 should be recognized in the statement of profit or loss, and it should also be adjusted to the value of the non-current asset, right? So the value of non-current asset should be reduced accordingly. Okay, that's all for information 4. Now we just need to repeat the same process for information 5. Let's have a look above. In December 2022, an employee was injured on the office premises. So this event took place at a past date. Then legal proceedings have started. The company's lawyer has advised that T Limited will probably be found liable and the compensation would be 9,000. As the case will be heard in court in April 2023, the directors had not accounted for the compensation in the draft financial statements. So in this case, we are talking about a possible liability in the future, which means that this is relating to our International Accounting Standard 37 for provisions, contingent liabilities, and contingent assets. Let's write it down. So that's IAS 37 of provisions, contingent liabilities, and contingent assets. Okay. And the employee was injured in December 2022, which means that the incident occurring in December 2022 is a past event. Let's write it down. The incident occurring in December 2022 is a past event. And we're also told that the company's lawyer has advised that T Limited will probably be found liable, right? So on the basis of this legal advice, T Limited is probably liable for the compensation, which means that it is a liability. Let's write it down. On the basis of legal advice, that T Limited is probably liable for the compensation. It is a liability. And whenever there is liability, provision should be made for the year ended that particular date. And in this case, we have our date of 31st December 2022 and the provision is of 9,000. Let's write it down. A provision of 9,000 should be made for the year ended 31st December 2022. Okay. Now this concludes the first part of this question. For the second part, we need to prepare a statement showing the adjusted retained earnings at 31st December 2022. All right, we start with the given value of the retained earnings, which in this case is 86,000. So that will be our draft retained earnings. Which is of 86,000. Okay, now we just need to go through each of the information. So we've already figured out what is to be done for information 4 and 5. Let's have a look at the first one. A proposed dividend of 0.05 per share had been accounted for and set against the retained earnings accordingly. The key word here is proposed. So if it is a proposed dividend, it means that it hasn't yet been finalized, which means that it should not have been set against the retained earnings accordingly, right? So let's figure out this total dividend. Again, the total dividend is just going to be the rate per share, which in this case is 0.05, multiplied by the number of ordinary shares. So let's figure out the number of ordinary shares in this case. We always start with the total value of ordinary shares, which is 400,000, and then divide it by its nominal rate of 1 in this case, which means that the number of ordinary share is also going to be 400,000. So that's 0.05 times 400,000, which results in 20,000. So while setting the dividends against retained earnings, While setting dividends against the retained earnings, remember that we always subtract it, right? But in this case, we've already subtracted it, which should not have been the case. So in order to reverse this effect, we're just going to add this amount of 20,000 back to our retained earnings, because this is a proposed dividend. Let's write it down. So that's our proposed dividend. Which was of 20,000. Okay, we are done with the first information. Now, for the second one, a machine cost 42,000, was purchased on 1st July 2022, and on the same date, T Limited had also paid 8,000 for a 4-year repairing contract starting on that date. So this is just our repair cost, right, which should be charged each year, and this is a revenue expenditure, which means that it should be included in order to figure out the profit for the year. And this is 8,000 for 4 years. So for 4 years, if it's going to be 8,000, then for 1 year, that's going to be 8,000 divided by 4, which results in 2,000. But remember that this was on the date of 1st July 2022, which means that the repair cost will only be utilized for the months of July, August, September, October, November, and December. So that's 6 months. For 6 months, it's going to be 2,000 divided by 2, which results in 1,000. So 1,000 should have been included as an overhead for repairs while calculating our profit for the year. But the total amount, 50,000, so the total was of the cost 42,000 as well as this 8,000 repair, was included in the machinery account. So this is absolutely wrong, because only the cost of 42,000 should have been included in the machinery account, which means that this amount of 1,000 has not been yet accounted for as an overhead for this year. And remember that this is an overhead which will be subtracted while figuring out the profit for the year, and the profit for the year itself is added in case of retained earnings. So this too makes up a negative, which means that we should be subtracting this amount of 1,000 from our draft retained earnings. Let's do that. So that's going to be our repair cost of 1,000, which should be subtracted. All right. Then depreciation on machinery is provided at 20% per annum using the reducing balance method, with a full year's depreciation in the year of purchase. And we are told that the machine cost in 42,000 was purchased on 1st July 2022, which is the current year, right? So let's figure out the depreciation for cost 50,000, because we have included 50,000 as the cost previously, right? That is just going to be 50,000. Even if it's the reducing balance method, for the first year, the cost will be equal to the net book value. So we can just multiply the rate of 20% to this amount, which results in 10,000. So this is the depreciation that has been included, which is the incorrect one. Let's figure out the correct depreciation now. It should be for the cost of 42,000, right? And that will be 42,000 times 20%, which results in 8,400. Okay, so this has already been included, and remember that depreciation is always subtracted. Now, in order to reverse this effect, we'll be adding this amount of 10,000, right? But now we also need to charge the correct depreciation amount, and this should definitely be subtracted. So we're going to add 10,000 and subtract 8,000. Let's write it down. And this is for the depreciation. We're going to add the 10,000, subtract the 8,400, which results in the positive amount of 1,600. Okay, we are done with information 2. Now for information 3, the only property of T Limited was revalued upward, so that's a plus, of 16,000 2 years ago, and this property was revalued again on 31st December 2022. The decrease in value, so this will now be our revaluation downwards, which is of 35,000. Alright, and this had been set against the retained earnings. So always remember that revaluation upwards should be added to our revaluation reserve, and in case of revaluation downwards, if the reserve has enough funds, then it can sustain the entire amount, but if not, then the partial amount would be sustained by the retained earnings. So let's have a look at our revaluation reserve. We're already told that previously it will have the positive value of 60,000, which means that 60,000 can easily sustain a loss of 35,000. So there was no need to subtract the 35,000 from the retained earnings. So we need to reverse this error. So previously it had been subtracted. Now we just need to add this amount of 35,000. Let's write it down. So that's 35,000 for our revaluation loss. All right, this concludes our information 3 as well. Now for information 4, we have already figured out that the impairment loss is to be of 3,800, which should be subtracted in the retained earnings. Let's write it down. So that's impairment loss of 3,800. That's the fourth one. Now for the fifth information, we've also figured out that a provision of 9,000 should be made. And the provisions are always made out of the retained earnings, which means that we need to now take out 9,000 from our retained earnings. So that's a negative amount as well, which means that we will be subtracting 9,000 from our draft retained earnings as part of the provision for compensation. Now we have adjusted all of the items, so we can now figure out our adjusted retained earnings. That's going to be the sum of these amounts: 86,000 plus 20,000 minus 1,000 plus 1,600 plus 35,000 minus 3,800 minus 9,000, which results in 128,800. This concludes the second part of this question. Let's move towards the third one. We now need to prepare an adjusted statement of financial position at 31st December 2022. So this is the statement of financial position. And this is at 31st December 2022. Okay, we will start with our assets section, and we can start from our non-current assets. Okay, we have to make the adjustment of non-current assets according to our information 2, as well as information 3, as well as information 4, because there was impairment loss as well. So previously we have the property, plant and equipment value to be 425,000, and we know that the cost of the machine had been overvalued by 8,000, so we need to subtract it since this is an overvaluation. Then we also know that there was an additional depreciation charge because we charged 10,000 instead of 8,400. So the additional depreciation was 1,600, which was subtracted before, but now we'll be adding it back. So that will be our plus 1,600. Then we had an impairment loss, and the impairment loss was of 3,800, which should definitely be subtracted from the asset itself. So that's minus 3,800. And this gives our correct value of property, plant and equipment to be 414,800, which is to be included in our corrected statement of financial position. Let's write it down. That is our property, plant and equipment. That's 414,800. Okay, that was all for our non-current assets. Now we can move towards the current assets section. Let's have a look above. The current assets is of inventories, which will not be affected, so that will remain at 42,000. We have trade receivables, again it won't be affected, so that's 225,000. Now other receivables, this will be affected because remember that we paid out 8,000 for 4 years repairing contract, but out of 8,000 only 1,000's repair has been made, so there is still 7,000 remaining, and this is prepayment of expenses which will be included in our current assets, right? So this 7,000 should be added to our other receivables now. So that's going to be 6,000 plus 7,000, which results in 13,000. And our cash and cash equivalents will also remain the same at 74,000. So let's write down these 4 items. We first have inventories with the same value of 42,000. Then we have our trade receivables with the same value of 225,000. We then have our other receivables, and we adjusted the advance payment of repairs, right? So it was 13,000 now. And lastly, we have our cash and cash equivalents. It's to remain the same at 74,000. Now let's figure out the total of our current assets by adding these four items. So that's 42,000 plus 225,000 plus 13,000 plus 74,000, which results in 354,000. We now can also figure out the total assets value by adding our non-current assets and the current assets. In this case, that's 414,800 plus 354,000, which results in 768,800. Now we can move towards our equity section. Let's have a look above. So the ordinary share capital is to remain the same at 400,000. Share premium will also remain the same, but revaluation reserve needs to adjust the revaluation downwards of 35,000. So that's 60,000 minus 35,000, which results in the value of 25,000. That's the new value for revaluation reserve, and we have already figured out the new value for retained earnings below. So let's have a look. The adjusted retained earnings was of 128,800. So let's write down those four items. We first have our ordinary share capital, which is of $1, and the total value is 400,000. We then have share premium, and the share premium is of 35,000. We then have revaluation reserve, and it has a new value of 25,000 after adjusting the 35,000 revaluation downwards. We also have retained earnings, whose new adjusted value we have figured out to be 128,800. Let's figure out the total for equity by adding these four amounts. So that's 400,000 plus 35,000 plus 25,000 plus 128,800, which results in 588,800. Now we didn't have any sort of non-current liabilities, so we can move towards our current liabilities now. Let's have a look above. Okay, we have our trade payables to be 152,000. This will remain the same. But for other payables, we are also creating a provision for information 5, right? And we have the provision to be of 9,000. So we need to add that amount. So that's going to be 39,000 plus 9,000. And we also need to adjust information 1, because remember that we had accounted for this proposed dividend of 20,000, which is no longer to be included as our other payables. So that's minus 20,000. This gives a new value of other payables to be 28,000. Now let's include these two amounts. So the first one is trade payables, which was of 152,000. We then have our other payables, which was of 28,000. So let's figure out the total of our current liabilities. That's 152,000 plus 28,000, which results in 180,000. Now we can figure out our total equity and liabilities. This is just going to be the sum of total equity and total current liabilities. That's 588,800 plus 180,000, which results in 768,800. Alright, in this case, you can see that the total assets value is equal to that of total equity and liability, which means that our statement of financial position is correct. This concludes the third part of this question. Let's move towards the fourth one. We now need to state 3 responsibilities of an external editor. So the very first responsibility is to examine the books and accounts. Let's write it down. To examine the books and accounts. Then the second responsibility of an external auditor would be to verify the value and existence of assets and liabilities. To verify the value and existence of assets and liabilities. And the third one is to carry out audit tests. Alright, this concludes the fourth part as well as the entire question number 3 of 2023 February-March paper 3-2. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.